So the last I checked, I still have $43,216 worth of Alibaba shares. For those of you who want to encourage me to do more outdoor filming, please remember to smash that cute little like button. But anyway, I think I just wanted to give you a quick run through in terms of my thought process today and cover a few main topics. First, I will talk about a few of my different portfolio performances to date because like I said, I wish to just record down what I'm thinking at that point in time and also share my learnings and share my reflections as and when. Secondly, I'll talk about why I still hold Alibaba today. Thirdly, the idea of value trap and whether Alibaba is potentially one. Fourthly, the idea of opportunity cost. And lastly, managing my entire portfolio exposure towards the Chinese economy and many of these Chinese stocks. So I have a lot to cover, so please go and grab your coffee and strap in tight. Now, I think in terms of my three main portfolios, actually I do still employ a lot more other brokers, but the three main portfolios I have today is Tiger Brokers, IBKR, which is Interactive Broker, and also Weibo. So I personally also use Moomoo, Scythe, etc. But in terms of the overall percentage and the amount of money that I have, these three actually hold the major positions. So essentially just to benchmark myself in terms of the different performances, the SPY is actually up 15% year to date. And on a 1 year basis, the last 12 months, it's actually up 17%. So I'm basically just going to benchmark myself against the main indexes that most of the people actually compare themselves to. So at least for my Tiger portfolio, year to date, I'm up 2.7%. Essentially, it's traded flat. And last 12 months, it's actually up 36%. So yes, I think in terms of my Tiger portfolio, I really started putting in serious money into this Tiger Brokers, and I basically built up my entire Chinese position. So mainly you have my Alibaba, my Tencent, my Chinese banks. These are the main few positions and it basically makes up the bulk of it. So if you do really study the charts of many of these different Chinese names, which is why on the last 12-month basis, I'm up 36%. Because this perfectly coincides with the election that was held last year. And there was essentially this huge hoo-ha where Chairman Xi removed the third term and he basically consolidated powers and there were many issues in between. But thereafter, suddenly they relaxed a lot of their COVID measures and then you see this huge recovery. Basically, they were in oversold territory and I think valuations were just crazy back then. Moving on to the second main portfolio, which is in IBKR. This IBKR portfolio actually started in April of 2023, very, very recently. It's currently up 4.8% and S&P in that same period is up 5.9%. On the third portfolio is actually my Weibo portfolio. This actually started in July of 2022. So based on the headline numbers that I see and I can pull out, I'll just put a screen grab here. It's up 13.3%. Versus the S&P 500 within the same period, it's up 6.9%. So you would ask me, why do I have so many positions in so many different brokerage firms? I can only tell you that a lot of them are running crazy promotions right now. And of course, just to diversify the risk on relying on just solely one broker. And I think more importantly, for my Weibo account, I do have my emergency cash in it as well because I park it in their Moneybo account, which is basically their cash management account. Weibo's Moneybo campaign is going to end in a few days' time, specifically on the 16th of November, 4 p.m. Singapore time. And you definitely wouldn't want to miss this. So I've personally participated in their Moneybo campaign the first time round. And this time, it's never been better. They actually lowered the requirements and you just have to deposit a minimum accumulated amount of $3,000. Keep it until the end of the event period. And also, don't forget to activate Moneybo to enjoy cash vouchers potentially worth up to $2,000. So Weibo also offers free paper trading to help you practice both your trading and also investing skills in the real investment environment with zero monetary risk. So this is of course to help ease you into the investment world, and don't forget, practice makes perfect. On top of that, Weibo has recently upsized their sign-up campaigns and new users to Weibo can now create, fund and maintain any amount in their Weibo account for 30 days and win 10 fractional shares worth between $100 to $5,000. Who knows, you might be the lucky one. So if you sign up on your own, you will only get 2 free shares. So remember to sign up with the link below now and get your 10 free fractional shares today. So for those without a Weibo account, I don't know what you're waiting for. Thank you Weibo for sponsoring this video. So now let's try to answer the age-old question. Why after 2 to 3 years of such an arduous journey, do I still decide to still hold Alibaba? I think this is a pretty complicated topic, but long story short, I'm just going to give you a summary of my thoughts today, which is the 9th of November 2023. I think before I begin breaking down, talking about the business, talking about the valuations, talking about why is this a once in a lifetime investment opportunity like I talk about basically every single video, I'll just start off with two quotes, specifically from the management team of Alibaba today. So Eddie Wu, who's currently the interim CEO, I'm not too sure whether they're going to find a new one, and I quote, Alibaba aims to become a tech platform company that serves the entire society's AI innovation openly. And I emphasize again, to serve the entire society's AI innovation openly. The second quote, which is from Zhou Cai, and I quote, 80% of the businesses in China and half of the large-scale models are running on Alibaba Cloud. So the AI open source platform, ModelScope, has over 100 million downloads and has become the largest and most vibrant AI developer community in China today. Unquote. So just let these two quotes sink in and just think about what exactly is Alibaba. I'm not trying to ask you a philosophical concept and ask you, oh, what is life or what is the purpose of life? But if you were to really look at it from that perspective and from the management's perspective, they essentially run the underlying infrastructure for many of your AI modeling, whether is it from your digital payments to your e-commerce, etc., etc. They really started out as just an e-commerce company and they started building up different verticals of the company. And today, they are your true blue tech company in China. So I think let's first ignore everything else. Ignore the political noise, ignore the impending invasion, ignore all the narrative and story building around the company. Let's just look at the fundamental business. So we know that Alibaba really started off as an e-commerce company where Jack Ma in this case discovered the idea that, hey, if you want to build a successful, a reputable e-commerce company, you have to obey to this theory of a golden triangle. A stable and trustworthy e-commerce platform, a fast and reliable logistics network, and more importantly, a trusted payments network. So essentially, over the last 2 decades, that's what they've essentially been building. They are currently the first in e-commerce, the first in payments, the first in cloud, top few in logistics, and more importantly, they have been a huge venture building company with an investment portfolio buying out or building out adjacent industries, adjacent companies, and even just outright buying out competitors. So think about the influence and the impact Alibaba has today. So I think simply put, in my worldview today, if I own both Alibaba and Tencent, I basically own the entire digital economy back in China. Think about social media, think about e-commerce, think about payments, think about cloud, think about whatever you can think of that is related to the internet. These two companies basically has their arms and legs in them. Moving on to the second part of the entire discussion, because in investments, identifying a good company, there's just one part of the equation. The second part is really the entire idea of valuations. So when I really talk about valuations around Chinese companies, I get a lot of pushback saying that, investor sentiments are never going to come back because of the haphazard government intervention and regulation. Nobody's going to beat up many of these Chinese valuations ever again. I think I beg to differ, but let me try to explain why. So let's first look at Baba's valuation on an absolute level. Let's compare to it itself. So their forward PE is currently trading at 9 times, and their free cash flow yield is closer to 10 to 12%. So name me a tech company that has the scale of Alibaba, or even comparable scale, that are trading at such valuation, printing this kind of cash flow, printing this kind of profits every year, and yet trading at this kind of valuations. I think Bears will also agree with me that they are trading at dirt cheap valuations. So the absolute valuation really is not the issue. So the bigger issue is really behind the idea of whether the valuations will ever recover. So let me just point you to two incidents. The first incident is, do you really think China is what it is today? And many investors, whether is it international sovereign wealth fund, whether is it your fund managers, etc., do you think that this is the first time they know of China and investing in China? The Chinese track record is out there for the last 4 to 5 decades. Let's not forget that Alibaba was trading closer to $300 per share, and today it's trading much closer to $80 to $100. So it was a 70% haircut in valuations. Why do you think in 2019, in 2020, they were able to achieve such valuations if when everybody was distrustful of the government, they don't trust the entire communist system, they don't think China is capitalistic? Where do you think this money come from? The second thing is, if you were to really benchmark this against many of the other bigger Chinese companies out there, say for example Maotai, just do a quick Google search and see what's Maotai's current valuation. They are trading, if I'm not wrong, 31 to 32 times price to earnings. Maotai is, yes, I agree, they are a high quality company. I also do think that Alibaba and Tencent are also high quality company. But why is one trading at 31 times and the other trading at 9 times, 10 times, 12 times, 15 times? it's really about all this entire narrative and story building. Tech is not the way to go. There's a rotation out of tech. So if investor sentiments change around this entire space, I do believe capital is going to rush back in again. So that's just my two very quick sharing in terms of the entire idea of valuations. Thirdly, I think circling back to the entire idea of wanting a piece of the pie of the entire Chinese digital economy today, really, I think there's a lot of potential upside moving forward in the next 5 to 10 years because of the alignment with where the government is looking at. Whether it's in terms of the advancement of technology, digital communications, high-end manufacturing, artificial intelligence, etc., etc. And I know some of you will bounce back and say that, oh, you're just throwing out all the very hot and buzzy words. I think not so. I went back to do a quick Google search on the 14th five-year plan, and coming out from the horse's mouth, it is an important period for innovation and high-quality development to accelerate the building of a digital China. So let that sink in for a moment. Who do you think are the two most prime companies to basically help accelerate and to help improve the digital economy of China today? I think you have the answer. I basically just want to own the foundational digital infrastructure of China today, which is namely the two companies that I have been talking about. Second last point, which is the idea of an opportunity cost. I think I've seen this comment littered on many of my videos previously and saying that, oh, you see, you have been stuck back holding for the last 2 years, 2+ years. Look at if you invested in maybe Tesla, Meta, Palantir, you could have been many times better off. This is not my first time talking about opportunity cost, but I'm just going to give a very, very quick summary because I've seen this time and time again. So opportunity cost is a very interesting and a very useful economic theory, but there's a few assumptions attached to it. So to give you an example, let's say I have $10 now. I'm deciding what I wish to eat for dinner. I have two choices. One, Western food for $10. The other one, Japanese food for $10. So the idea of opportunity cost basically lies on what is the next best alternative that is forgone. If I choose the Western food, I basically forgo the $10 Japanese food and vice versa. However, if you were to bring this concept from the economics world to the finance world, it really doesn't mean anything. In order for you to make the assessment of what is the next best alternative, you have to have a concrete answer. Concrete meaning 100% guarantee of how the other instrument is going to perform. All we have in the finance world at least, to be very, very honest, between asset classes are just historical returns. And between different equity names, the best we have is historical beta, which explains the volatility. So we can make educated guess, but we have no guarantee on how one investment is going to outperform or outclass the other. So that's why this idea of opportunity cost, I think it should stay in the economic world. In the finance world at least, what we do here is really calculating our own IRR, our internal rate of return, our hurdle rate, basically our target rate of what we want to achieve when we go into a particular investment. And at least in my perspective, I do think that even though being 2 years, 2.5 years late or behind some other investors, if Alibaba do a double bagger or triple bagger from here, I'm able to catch up in terms of my IRR. So that's just basically my own thinking and my thought process on how I frame this entire discussion of opportunity cost. And I think last but not least, let's talk a little bit in terms of my overall exposure. So the last I checked, I have around a 70 to 75% exposure in my entire portfolio to the Chinese economy. I think I've come to realize and appreciate a little bit more of the lesson of diversification. Diversification not just only in different industries, but all of them rely on one factor, which is the Chinese economy to recover and money to flow back to China again. I have been on the side accumulating US tech, even some very strong Europe names like LVMH. I floated in one of my previous videos. So that is basically what I'm going to do. I think my Chinese exposure is sufficient. My current life stage, given that I'm still contributing very aggressively to the portfolio, I think I'm just going to keep my Chinese exposure, and just by the pure contribution of new funds, where the percentage will basically balance itself again. So just some parting words. I've met up with a group of friends, and one of them basically asked me, hey, so is Chinese tech still a good time to buy, or is Alibaba still a good stock to buy? Knowing me, of course, I've basically built an entire channel on one stock or a few stocks, and I've been a huge bull. And I know a lot of people have come and go. A lot of people have been huge bulls, and they also sold out because it was an extremely tedious journey. The stock just kept going down and down and down, and there's no end in sight. The Chinese economy is not going to go anywhere. You do see a lot of narrative and story building of how people is diversifying their entire supply chain. But based on my own research, I think we are far from it, at least not in the 1 or 2 decade, or not 1 or 2 years. On the stock market front, like I alluded, basically a lot of things are just in rotation. And right now, Chinese equities are just out of rotation. I definitely believe that they're going to come back stronger. And I think my perspective is simple. You don't have to be as huge a bull as me to allocate 70-75% of your portfolio in just one industry or one thesis. But really, all things considered, business fundamentals, the tone from the top, valuations, everything look extremely appealing. And even just having a tiny bit exposure, even if it's 2%, 3%, 4%, I think it probably wouldn't do you much harm. With that, I'll see you in the next video. But more importantly, I will finally see you on the moon.